You ever look at the US housing market and just think, what is going on? It feels totally stuck, right? There's a ton of demand, but it seems like nobody's selling their house. Well, today, we're going to get into the single biggest reason why. It's called the mortgage rate lock-in effect, and we're going to see how it's just now, very slowly, starting to loosen its grip.
All right, so let's get right to the heart of this thing. People are calling it the golden handcuffs, and it's this weird, kind of backwards situation where having something amazing, like a crazy low mortgage rate, is actually the thing that's holding you back. It's a problem that's also a great deal. Bizarre, right? I mean, think about it. This is the question millions, and I mean millions, of homeowners are wrestling with right now. You're sitting on a mortgage with a rate of, say, 2.5 or 3%. Why on earth would you sell your house just to go out and get a new mortgage at 6 or 7%? It feels financially insane. And because so many people feel that way, the market has just ground to a halt.
So there's an official name for this, of course. Economists call it the lock-in effect. And really, it's just a fancy way of saying there's this massive financial penalty for moving. It has basically flash frozen a huge chunk of the housing supply, stopping that normal flow of people buying and selling that keeps a market healthy. Okay, so the big question is, how in the world did we get here? How did literally tens of millions of people get these incredible rates in the first place? Well, to figure that out, we've got to jump in the time machine and go back to a very, very weird time, 2020 through early 2022. You'll remember this. During the pandemic, the Federal Reserve basically pulled out all the stops. They slashed interest rates down to zero and started buying up trillions of dollars in assets, including the stuff mortgages are made of. The source we're looking at calls it a tsunami, and that's a perfect word for it. It just flooded the market with cheap money and kicked off this unbelievable stampede of people refinancing their homes. And the result of all that? It was just staggering. Get a load of this number. At its peak, in early 2022, 65%. That's nearly 2 out of every 3 mortgages in the entire United States with an interest rate below 4%. Just let that sink in for a second. And you can see just how dominant this became. That giant chunk of the pie, that represents millions and millions of homeowners who locked in borrowing costs that honestly feel like a fantasy today. It's hard to even believe those rates were real. The author of our source material, Wolf Richter, he has a great name for this. He calls it free money. And look, that sounds like an exaggeration, but it's literally true. Think about it. If the money you owe is growing slower than prices are rising, that's inflation, then the real value of your debt is actually going down every single year. It's like borrowing for less than nothing. And this is where things just get wild. For a while there, the situation was completely upside down. You had average mortgage rates way, way below the rate of inflation. So in real terms, you were actually making money on your loan. It's no wonder our source calls this period the craziest times ever in the mortgage market. Because it was. Okay, so what happens next? What were the consequences of all this? Well, this huge pileup of super low rates had this massive ripple effect. And according to our source, it was actually pretty damaging to the whole housing market. Here's the key takeaway. It created this huge shock to the supply of homes for sale. Homeowners everywhere looked at the new, higher rates, then looked back at their own sweet 3% deal and said, nope, no way, I'm staying right here. And just like that, the number of homes on the market, the number of sales, and the number of new loans, they all just fell off a cliff. And yeah, our source material is really blunt about this. It argues that these policies delivered a nasty 1-2 punch. First, they fueled this historic explosion in home prices. And then the lock-in effect came along and created a total drought in sales that haunted, and that's a direct quote, the real estate agents and mortgage brokers who depend on those sales to make a living. And we're not just talking about numbers on a chart here. This had a real human cost. When transactions dry up, so does the commission and fee income for a whole lot of people. We're talking real estate agents, mortgage lenders. The industry saw waves of mass layoffs, and a lot of folks just decided to get out of the business completely. So if the financial incentive to just stay put is that strong, what could possibly break this spell? What could make someone give up their golden handcuffs? Because something is happening. The market is very slowly starting to unlock. Well, the answer's pretty simple, and it's something we can all relate to.
life just happens, you know? You can love your 2.75% mortgage rate to death, but it's not going to stop you from getting a new job in another city, or getting a divorce, or having another kid and needing more space, or your boss telling you it's time to come back to the office. These big life events don't really care about your mortgage rate. They force you to move anyway.
And that steady, unstoppable drumbeat of life events, well, it's finally starting to show up in the hard data. We can actually see it chipping away at that massive wall of locked-in homeowners, one sale at a time. And here's the proof right here. Remember that peak number, over 65% of mortgages being below 4%? Well, that number has now dropped all the way down to 51.5%. That's a really big drop. It means every single month, thousands of people with those perfect mortgages are selling their homes, and those loans are disappearing from the books. So you can really see the whole story laid out here. We hit that absolute peak in early 2022. And ever since then, it's just been this slow, steady decline as that life happens factor does its work, gradually untangling this massive knot in the housing market. So the big takeaway here is that the great lock-in is definitely starting to fade, but man, it is a slow burn. And that leaves us with one last really important question to think about. What happens if another recession hits and the Fed is forced to slash interest rates all over again? Could we find ourselves right back in this same situation with a whole new set of golden handcuffs? It's something I guarantee you policymakers are thinking about right now.